Hello everybody and welcome to our webinar. We're just going to wait until the clock hits the hour for those who are logging into WebEx, and we'll be starting in just a few seconds. Great, so welcome everybody to our webinar on what works for smallholders and agribusiness. My name is Caroline Ashley, and I'm delighted to host you today on behalf of the Practitioner Hub, of which I'm the editor. We have two excellent speakers with us today, Jessica Graf from Hystra and Hugh Scott from the African Enterprise Challenge Fund. Let me tell you first about the structure of what we're going to do today. Both of these organisations have wonderful insights on a range of issues to do with what works for smallholders and agribusiness. We're going to start with a quick quiz on 5 of the topics on which they have some interesting findings to find out your views, and then they will share their perspectives and their evidence and their experience, and then we'll have time for some short discussions with Q&A at the end. Please feel free to put your questions into the chat function at any time. We'll come back to them at the end, and you can see the hashtag for the discussion on Twitter. Oh, someone's just joined on a video. I think I'll leave the coordinators to sort that out and we will move on. So what are we actually talking about today? The purpose of our discussion is to bring together 2 quite different data sets. I read both of these in the last few months and really found both of them to be so strong, interesting, and in some ways unique because they were truly sharing data. Hystra have reviewed hundreds of agricultural initiatives, and they did a deep dive on 15 of what they considered the best. AECF has a long-standing portfolio of over 120 agricultural businesses, agricultural projects, and they have recently shared their data and findings. So you put these 2 together, and we are hugely increasing the amount of practical insight we have on this question of what works for smallholders. We know there are many productivity-enhancing products and practices that could benefit smallholders, but we know there's a huge number of issues as to why they don't get taken up by the 1.5 billion small-scale farmers and the next 1 billion larger-scale farmers. So what we will hear today is the views of our panelists on what can make a difference. I'll first ask Jessica to introduce their data set. Jessica.
Yes, thank you, Caroline. So just to give you an idea of where the findings from discussed today come from is actually, as Caroline said, we browsed the hundreds of companies and we selected 15 where we think we could learn from what works. We didn't focus on, documenting further why is it so difficult to work with smallholder farmers, but we tried to deep dive on those companies that that found fixes and innovative ways to work with the small farmers. Despite the fact it's only 15 companies, it's quite an interesting sample given that they work in 15 different commodities, and in total they work every year with over 2 million small-scale farmers.
Thank you, Jessica. And now, Hugh, could you introduce your data set, where your evidence and experience is coming from? Hugh, are you there? We'll just wait 1 minute for the connection to be made.
Okay, Caroline, I hope you can hear me now.
Yes, we can.
Hi, thank you, Caroline. Okay, very briefly, for those that don't know, the Africa Enterprise Challenge Fund is a donor-funded vehicle which awards grants and loans to sustainable business and business projects that reduce rural poverty. We work particularly in the area of agribusiness, but financial services and information also for the agribusiness sector. We started in 2008, and since that time we funded over 200 projects, of which about 120 or so are directly in agribusiness, another 20 there in financial services. On an annual basis, we produce an impact report that looks, as it says, at the impact of the AECF in terms of 6 key indicators. Those indicators are the 2 of them on business performance, the turnover of the business and EBITDA, the profitability. 2 of them related to jobs, the number of jobs created in the businesses we support, and the amount of additional value in terms of wages that's been generated. And perhaps most importantly, the number of rural households that are benefiting from the AECF and the amount of money benefit per household. We produce this report on the calendar year basis, and it is that data set that we are looking at today.
Great. Thank you, Hugh. So now, first of all, we want to hear from you, the participants. We have got a short quiz, and in the chat box, you can see the link. Please, I hope you can see the link. Please, can you click on the link? Sorry, I will just send that link. I thought it was in the chat box. 1 second. And we have 5 questions, and we would like you to we're going to give you 1 minute. Please just go to this link, and you've got, well, actually 1 minute and 15 seconds, because we thought 15 seconds for each one. It's a multiple choice quiz. Please put in your answers, and then we're going to take the discussion through all 5 of these questions and hear from Jessica and Hugh, their perspective. I can see the results as they come in, and I will share the results with you as we go through them all. So everyone, I hope you have got through to your link okay. Please let us know in the chat function if there are any problems. Okay, keep your answers going in, please. Now, I know there's more people on the webinar than I can see answers for so far, so I am going to give a little bit longer for you to get through these answers. Okay, we're doing well now. Thank you very much, everyone. We'll still give you another half minute. I hope you find the questions clear. We have lots of answers coming in now. Great. So I'm now going to start the discussion on the first question. We've got 30 responses, 31. And if you want to continue the last people with your answers, that's absolutely fine. For questions 2, 3, 4, and 5, we will capture them. So let's come to the first question of whether businesses can make money by working with smallholders, either as sellers or buyers. And in terms of responses, oh yes, almost 70% of you have said yes, and often in significant ways. 30% of you have said yes, but in a limited fashion. So now let's first ask Jessica to share your views of what have you found, what evidence have you found on this question?
Thank you, Caroline. So I don't see the right slide, Caroline, but so the right answer for us is number 3. So congratulations to the 70% that guessed it right. There is a lot of people who say, oh, it's impossible to make solid business with very small farmers. This proves to be not correct in many cases, as you can see on the slide. For buyers of agricultural production, sourcing from very small farmers can be actually very attractive financially in terms of additional net margins. Many of them, if managed to translate these into a premium, price premium that ranges from 11 to 24%, and many others manage to actually get additional margins out of logistical gains or better quality of produce of 2 to 5%. For the agro companies that sell inputs and equipment to farmers, these represent small farmers are an extremely attractive market because it allows these companies to actually grow their customer base by 3 to 5 times versus their previous, only larger farmers' customer base. So in general, there is money to be made at the bottom of the pyramid, as we say, and it can be an attractive value proposition for these agro companies.
Great, thank you, Jessica. Very interesting that you have strong evidence, both those buying from and selling to farmers. Hugh, will you share your perspective?
Yes, we didn't actually capture this particular question in our impact study, but we have evidence that would tend to support this very clearly. You see the graph in front of you there. What that is looking at is the average revenue per project, depending on whether the projects are 1-year-old, 2-year-old, 3-year-old, and 4-year-old. So what you're seeing there is that as the projects get older, the revenue and the turnover generated by those is increasing substantially. We've presented that by the different sectors or subsectors. So you can see there input supply, outgrower, agro-processing, marketing, distribution, and you can see those increases over time. So something is happening, and as profitability, one assumes in due course of time, will follow turnover growth, then we're looking positively at these numbers. But as yet, the EBITDA, the profit figures, do not indicate as clearly this growth, this picture you're seeing from revenue growth. So for us at the moment, revenue growth is key, and EBITDA and profitability hopefully will follow.
Great, thank you, Hugh. And we'll come back and ask you about some of the differences between EBITDA and profit and sectors later. Thank you. So on question 2, what's the single biggest lever to increase the profitability of farmers? We have some interesting replies here where almost, 63% have answered training on better agricultural practice. The next answer is 25% say higher selling prices, and less than 10% provision of new technology and 3% savings. So, Jessica, do you want to enlighten us on what your data shows?
Yes, please go to my slide. So, I must say that I beg to disagree with most of participants, but perhaps it's a question of how you interpret the question. Basically, we look at what are the drivers to improve farmers' profits or net income compared to the previous practice or the previous year. And we have looked at 3 main drivers. The first one is increasing production and productivity, meaning the farmers produces more. The second one is give farmers a better price for what they produce, and the third one is anything else like dividends, savings, and you name it. And what you can see is that the dark green bars are by far the most important driver to significantly improve farmers' profit. If you want to increase farmers' profit by more than 80%, it's a necessary condition to drive these high numbers. And these, how do you best drive increasing production and productivity? By giving farmers the means to do it, meaning you give them productivity enhancing inputs and equipment, and it can be many things. It can be a hybrid cow that is yielding more milk. It can be quality or better adapted seeds for their soil and climate. It can be micro irrigation system. So basically, any form of technological improvement that will allow them to increase their yield. If you give them that, there is good chances that the farmers will actually increase the productivity and production in significant ways, and then the profit will come in. To give farmers higher selling prices, you need to give them market access. And if you do that alone, what we see is that you won't move the needle just by giving them a tiny bit more better price, or even 10% improved price. You won't move the needle so much for farmers. And perhaps what this slide also says is that, however, if you combine both, meaning if you provide them technology and you also provide them better market access for the increased production they have, then you can really hit bingo and have farmers earning up to double, even more profit. The part of the slide that shows that everybody was right is that in all our projects we look, they give technical assistance. It's a must. You cannot not do it. You have to do it. It's a prerequisite. You cannot give a new technology without explaining farmers how you do it, how you use it. But doing technical assistance alone and just showing farmers how to farm better won't make it. That's our experience.
Really interesting, thank you. So training is helpful, but on its own, it's not the solution. It's actually the productivity increase in technology. Thank you. Hugh, what's your perspective on this question?
From our point of view, the key issues we're looking at are, as I mentioned earlier, the two indicators are the number of smallholder farmers that benefit from a particular project, and also the actual net benefit per household from that particular business. So what we did was look at our portfolio and try to see which sorts of projects gave us very large numbers of households benefiting, and which types of projects gave us higher benefits per household, and which types of projects might give us both of those, which is obviously the nirvana we're looking for. And the analysis we did, as you can see on the screen here, we concluded so far that when the smallholder is a consumer of inputs or other items like information and finance that are produced by the company we support, we get larger numbers of households but less benefit per household, as compared to projects where the smallholder farmer is a producer of product that is bought by the companies we support. If we can move to the next graph, can you move to the next slide, please?
There's a lag. Sorry, carry on.
Okay. If we can continue that subject further, when we investigated this more, what it actually concludes, if you can now, you can see this is on the screen, that the greater the engagement that the business has with the individual smallholder, on average, the benefit per farmer will increase. So if you're talking about just providing information to a small farmer, or just providing inputs, you can hit lots and lots of farmers, but the benefit per farmer is lower. But if you provide inputs and you're running an outgrower scheme where you're involved with the farmer directly, and then actually buying from the farmer, and in cases using processing and marketing and distribution, the further you go up that curve of engagement, the greater the benefit per farmer will be. Okay?
Fantastic. Thank you very much, Hugh. So we have some interesting differences between the number of farmers reaching and the benefit, but some clear messages about the level of integration, which to some extent, as you say, correlates with Jessica's finding about the combined issues that go together. I'm going to move us on to question 3, which is why do some projects struggle to reach high penetration? Because as we said right at the beginning, there's a host of good technologies, processes, goods and services out there, but adoption is not always scaling. In your answers, 45% of you gave the third answer, that farmers are risk averse, yet not given any insurance or guarantee against failure. 27% of you gave the second answer, that the gains they see are not significant enough. 15% of you gave the first answer, that farmers cannot afford to pay for the expensive new technologies. And 12% of you said other. We might in the chat come to what people consider the other. But first, I'm going to ask Hugh to give a perspective from AECF on this question, and then we'll turn to Jessica's data.
Yeah, we haven't got data on this subject. We haven't actually studied our portfolio to look into this in detail, and obviously it's something we'd perhaps like to do going forward. But just from anecdotal evidence, when talking to the project, we feel that some of this is to do with the opportunity cost. In other words, where the innovation or the business idea has very little downside, then the adoption is much higher. What if the opportunity cost of taking on that new innovation, then the farmers, the uptake is going to be much lower. Just to give very simple examples of where you're going to get very high take-up, you would get it for something like if you were having a program on avocados or something, or a tree crop, but where those tree crop are going to be in an intercrop situation where you're not losing very much on the productive side for what you're growing now, then the uptake is much more likely to be higher. If you had cocoa, for instance, and it was a cocoa plantation, while you can get some other income between the crop as it's growing, it is going to be, if it's a full field or plantation, then the decision to do that is a much tougher decision, and the level of penetration will be lower.
Fantastic. Thank you for that emphasis on opportunity cost. Jessica, let's hear your rather interesting angle on this.
Yeah, I would love to know what the people who voted other had in mind, because this is what we found out. We actually wanted to understand what drives penetration. So technically, what kind of value proposition do you get farmers sufficiently interested in to join your program, or to buy your product, or to sell your product, to sell produce to you? And we thought our first hypothesis was that farmers would be attracted by the money they could make, meaning if they would gain, if they would earn a lot of money, then this would attract more of them. This is obviously not the case. You see absolutely no correlation between the penetration column and the second column. You have some projects that have only 15% penetration, while they provide absolute whopping benefits to farmers. And then we thought it's a question of costs and investment levels, meaning if farmers need to invest a lot, then they would be reluctant to do so, and it's also not related. Digging further, looking at specific cases, what we found is that there is some correlation with what we call ability to quit project easily, meaning if you offer a two-way ticket to the farmer, if he joins your program and he can withdraw from it very easily, if he's, for instance, if it's a failure, if he doesn't like it, if he changes his mind, and so on. So, and however, if you give them a one-way ticket, meaning it's extremely difficult for them to go back to what was before, they're extremely reluctant to join. This is, for instance, the case for bioconversion projects, meaning farmers need to join your program for 3 years and do bio, I don't know how you say in English, but organic and only organic for 3 years, and only then they get to reap some benefits. They cannot go back during these 3 years, otherwise they lose everything. If providing them guarantees and insurances sounds like a good idea, but it has absolutely no bearing on how they behave. Farmers decide to join or not to join, not because you tell them that they might perhaps get a payment if they die or if it doesn't rain. But that doesn't drive the behavior. It's more like something you offer to the farmers to make sure they're covered.
Great. Thank you, Jessica. So it's got a similar angle there to Hugh's emphasis on opportunity cost. What are you giving up? But it's actually about how you get away from what you've just taken up to get back to where you were. Really interesting. Thank you. I'm going to move us on to our next question, our next set of answers, which is about training. And remember, 75% of participants said that training was probably the most effective tool. Jessica certainly said that training and TA is essential in all the projects they have looked at that have success. In our quiz, half of you, well, 47% to be precise, said organisations spend between 1 and 10% on training, 1 and 10% of either the product bought or the input sold. 22% gave the next two answers. 22% said 10 to 20 and 20 to 30, and 9% said more than 30%. So between 1 and 10 is the majority answer. Jessica, let's hear from you on what you found.
Yes, so the right answer is answer D. Well done, the majority of those who answered these. How much money does this translate per farmer per year? It's actually, if you bring it into actual dollars, it's a very wide range. It's from $9 to $500 or $600 per farmer. And what we found, however, is that independently from the frequency, how much you invest into the farmers and how often you go and see them and how much hand-holding you do, is that in terms of impact over the farmers, it is completely uncorrelated, meaning more is not better. So this is a big finding for us because it seems that projects really struggle to calibrate the right amount of training they spend and invest into farmers. They should rather look into what really improves their income. And as we saw at the beginning, it's really about increasing the productivity. So perhaps some projects would do better to decrease the training investment and give farmers perhaps better seeds. Then the impact could just be much, much higher. If we go on to next slide, we argue that actually for companies training farmers, they should look into the numbers a bit better, because the holy grail would be for each dollar invested into training a farmer, that the farmer makes much more money, which we see on the right-hand side, and the company earns a better margin, right? And what we see is that among the buyers of our project, very few manage to do that well, meaning for each dollar invested, the company itself would get a bigger return and the farmer would get a better return. So the message here is that more training is not necessarily better, and to calibrate it, look at the impact it has on your bottom line and that of the farmer, and try to find a sweet spot where you make it a win-win situation.
Great, thank you. I think depending on how discussion time goes, we might come back to probe an example of what really works well a little bit more there. But for now, we'll move on to our fifth and final question in the quiz. And I just want to pause to say there's some very interesting comments and questions coming in. Some of them are sent directly to me. Some of them are public. If you are happy to share it, please do share it publicly, because they're very interesting, the comments that are coming in. I will do my best to bring them all up in our Q&A after we've done the last quiz question and a little bit of wrap-up of the presentations so far. So, fifth question. The whole question of default. Default and side selling, a very common conversation. What did you think were the effective strategies to deal with defaulters? 40% said all of the above. 30% said offering more stable income. 27% said increased transparency and convenience in transactions. And one person said enforcing tough penalties. So, Jessica, let's hear from you. What did you find?
So the majority is again, right, it's all of the above. I think if we knew how to fix the side selling and the defaulting problem, I think it would be on. There is no single silver bullet to the problem. What we find, if you could go on to next slide.
Yeah, sorry, we'll go back to Hugh's slide in 1 second.
So it's a combination of the above. What we saw, that one of the things that is extremely effective is to help farmers, earn a salary, meaning you make their income more predictable. And there is many ways to do that. For instance, Margarita, which is a Danone project in Mexico, offers farmers a price band, meaning when the prices are very high, they pay them a little less, but when the prices are very low, they pay them a little more. And that, what does that make is that farmers know they will anyway, whatever happens, earn a revenue within that band. And that gives them a security that they value enormously, because they can plan and invest and anticipate. The second example is from Biopartenaire, a cocoa buyer in Ivory Coast, and they used to pay premium for certification during the planting season. And what, interestingly, you might have expected that farmers would just grab any money on the table, but farmers actually asked for the company to pay the premium in a lump sum after the planting season, when money was scarce and expenses high. And again, it's an income smoothening mechanism that makes sure that they see some income coming in home throughout the year and at a reasonable level. The other example on next slide is something about convenience and transparency. You would be amazed by how much farmers value these two aspects, and you can bring the loyalty up significantly by focusing on those. So these are two cases from Biopartenaire. You can see that if you offer the farmers to pick up and transport their harvest to the place where it's being sold, from the farm to the place it's being sold, then suddenly the number of farmers willing to work with you will increase 20%, because they just value this convenience and this service. The transparency is very important. Same thing, if you do mechanical weighting versus digital weighting, then 84% farmers extra will come to be able to weigh their harvest on a digital scale, because they somehow trust the numbers on the digital scale more. And the last thing we've seen is that not only the carrots work, but the sticks are sometimes necessary, and this is what we see on next slide, which is the Margarita project. Basically, they have a very strong stick, because each farmer that is part of this project has the right to a bonus that accumulates year long. And whoever leaves the project during the year, even if it's month 11, loses the full bonus. So in many cases, people just stick on because they would think, oh, it's too bad to lose the bonus. The other stick, very strong stick, is that those who leave the program are excluded for life, meaning they cannot change they cannot change their mind anymore. And you can see the numbers for milk sourcing projects. For those who know the industry, the numbers are just flabbergasting, because it's 0 site selling and 5% churn. So it's extremely, extremely low.
Great, thank you. It's really interesting what you're saying. Every time you describe these strategies, I'm thinking, well, this is exactly what Tesco, Amazon, and all the companies that are trying to sell to me are doing, all about loyalty and convenience. And there are such parallels, what you're raising, across different economies and different sectors. Hugh, I know you have some interesting perspectives to add here on when side selling is particularly difficult, and how you see some of these issues of price and trust and so on. Can we just go back a couple of slides to your slides to hear your comments? Yeah, great.
Thank you. Again, this is an area where we have more anecdotal experience than we have data, but it is something we can delve into more in the coming years or so. I suppose our general finding would be, that it's particularly difficult with food crops. There are lots of opportunities to sell such food crops to others. If we could find good ways to run outgrower schemes with food crops where the farmers would really benefit at the same time as the company benefit, I think would be terrific. But we don't see, we've backed a number of trials and projects in that area, and as yet we're not seeing much success. Where the defaulters are low and the side selling is low is where you have closed chains with high returns. You've already mentioned milk as one of them. Broilers is another. Tobacco, although we don't deal in it, is another. But where the returns to the farmer are high, there is a buyer that is there year in, year out. There is a processing or something going along with it, a milk collection center or someone buying the broilers on the contract, and the returns are high, then you get very low default. The other time you get a high default is where you get a semi-closed chain, but with poor returns. And our experience in that area would be something like cotton. It's really hard to keep the default low with a crop like cotton, where in many cases, particularly in East Africa, the returns to the farmer are very low, and the cost of the inputs are very high. And the temptation to sell to somebody else where you don't have to pay back your loan is particularly significant.
Great, thank you, Hugh. Yeah,
Okay.
Interesting point about the ratio between the price of the inputs and the income from the outputs. So that's a very quick canter through some of the evidence and findings on just 5 topics. But there's plenty more that I know both of you have learned. And Hugh, there's several other points in your report. Let's give you the chance to summarize the key findings from your report beyond what we've already shared.
Okay. As I mentioned earlier, we've done much of our study was related to looking at the different types of businesses and different types of projects, and what do we find about their performance in terms of impact and business from it. Our key findings on impact, we're 7 years old. Last year, 2014, 7 million rural people benefited from the AECF. We're extremely proud of that number. We're very confident that that number is going up in 2015 as we go forward. I mentioned earlier that it is companies that are providing inputs to farmers, where farmers are consumers, where you get the largest number of households, where you get the biggest benefit is those where the households are producers or suppliers. Pareto rule applies. 80% of our impact is coming from 20% of our projects, and it might even be more severe than that. I don't think we should be surprised at that. The challenge for us is, can we identify ex ante which ones are going to be the 80% of the impact? Livestock projects, dairy and poultry projects particularly, seem to have a greater impact in terms of income increases per household on average. We've got to have patience. The real impact of agribusiness projects is seen over a considerable length of time. And that's not just because they're plantation crops taking 5 years to produce. It's just that it does take time. Impact correlates almost directly with revenue. The EBITDA relationship is taking longer to show. But if we can back businesses that are really growing, that's where we're getting our impact from. Jobs is becoming the focus for funders, for many of our funders. And we've really underplayed the way the impact we have on jobs by concentrating and looking at the number of households and the benefit at the household level. If we recalculate our data in a different way, we can actually show, we believe, that the program is having a big impact on jobs as well. Lastly, on impact, we would say there's a huge opportunity to learn from the AECF's portfolio. We have, as I mentioned, over 200 investments now, and that is a fantastic laboratory from which to learn from. We really appreciate the work that Jessica's done, and we would like to take on some of the things to see whether the findings that Jessica has found is consistent within our portfolio also. So we'll be talking with Jessica, but we've also got lots of other interesting learning studies we want to do. The next slide, just some key findings and questions on the process. The AECF is actually not one fund. It's 8 different funds. We've run 20 competitions. We've raised $244 million. We have over 200 projects, and we work in 25 countries. That's quite something. And what have we learned about the Challenge Fund process and the process of what we do? We've taken on board what we call the last hard number approach to measuring impact. Now, what we need, what that is about, is that we believe in every business there is a number that business collects automatically to do its business that is the nearest number to what the impact will be. And our job is to set the causal relationship and understand it between the last hard number the business collects and the impact. Why do we need this? Because if you've got a very large number of businesses like we have, we can't go out and do impact verification studies on 200 businesses. It would cost more than the program. So we have to take a short circuit to doing some of this. I'd like to explain it more, but very, very, very quickly, the last hard number for a seed company is the amount of seed it's sold. The last hard number for an outgrower program is the amount of money that they've paid each individual smallholder. They're different, but each one gets us the nearest point. We run competitions both by country and by topic, and we also run continent-wide competitions. They both offer different results. Our country and topic-based competitions offer greater potential for having a market systems impact, because we can concentrate on subsectors on the one hand, and we can design competitions to solve problems on the other. Continent-wide competitions, though, which are much more open, are probably the best way to find the most innovative ideas. And if it's innovation that really has the impact, then we need to consider those two. We aim to start races rather than pick winners. In other words, we're different than a venture capitalist who says, well, in this area, this is the best business, we back it. Our job is to try and get a race going. We've done that in a number of areas, and you can get much more of a market systems impact that way. Innovation, we mentioned we're an innovation fund. The innovation per se is not the key. Disruptive innovation is the question. You can have nice innovation that's very niche, but it will only affect very few people. We're looking for innovation that changes the market systems and then has a broader impact on lots of others. Disruptive innovation causes replication, means that others have to copy and follow. So if we can find them, that's what we're looking for. One of the big challenges for us going forward, as it has been to some extent in the past, and with challenge funds more generally, what sort of financial products should we use? Should we just be a grant provider? Should we provide loans? And if so, what sort? Should we provide guarantees and equity? There are many questions that need to be answered in that regard. One thing we are sure about is we've added a program called Connect to our fund, whose job it is to help our growing businesses access commercial finance. That's been very successful. As yet, the grants, loans and guarantees question is a very open question. The other question on challenge funds that is interesting is around matching funds and leverage. Many people don't appreciate they're not the same thing. Which one really matters? Is it that we should see that the business is at risk with us, or is the issue that we should be getting our growing business to leverage money from commercial sources? I'm going to stop there, but we have lots of lessons to learn on challenge funds, and we believe it's our duty to write this up much more than we have done to date. Thank you.
Brilliant. Thank you, Hugh. You can see why we are suggesting that you look at the whole AECF 2014 impact report, which contains all those findings, including 10 wonderful, short, crunchy findings about challenge funds, some of those process issues that Hugh touched on, plus all the fascinating detail on impact, a little bit of which I hope we will come back to. I also strongly recommend that you look at Hystra's whole report. You can see that here and a list of lots of other information that you will find in that report, in addition to the data that Jessica has already shared from you in the evidence supplied to the quiz questions. So really and truly, I have found these two of the best reports I've read on agribusiness in a long time, and they happen to have both come out at a similar time. So congratulations to you guys. So now, moving on, let's I would encourage you to use the chat function, put in your questions, ideally share them with everyone. We have heard a lot about the evidence of the benefits to both farmers and businesses, and we've seen some graphs and hard numbers and multiples, which is really nice. We've discussed what works in terms of increasing smallholder income and the emphasis on productivity, increasing technology and value chain integration. We've heard about the returns on training input and how variable that is, but how important. We've heard about the strategies to increase adoption in the face of risk and the reversibility of decisions, and strategies to reduce default. Now, we have a few questions already, which I'm going to kick off with. First, a very practical one. Can we get the slides after the webinar? Yes, of course. The slides and a recording of this webinar will be on the Practitioner Hub page for the webinar, and the last slide, the penultimate slide in this deck, will give you the bit.ly that you can easily take for that, bit.ly/smallholder. So that one's a yes. We've also had two questions specifically for you, Jessica, on the analysis of the training. One person asked whether the spending was just the contribution by the specific party or included training contributions by others, and another person asked about the quality of the training. So let's just quickly deal with that factual question, and then I want to come to some of the more bigger questions, including the smallholder as agent, on which actually both reports have touched, although we haven't discussed so far in the webinar. Jessica, can you fill us in on training?
Yes, so on training, we looked at the total training expense, including what the company was investing, plus grants, if any. What we've seen is that training is paid in-house by the company in most cases after they reach break-even. So one could argue that grants sometimes are useful or helpful until a company reaches break-even, but afterwards it's probably not a good idea.
Great, thank you for that. Now, let me try and merge a couple of these questions. Both of your reports, and Hugh, particularly your summary, talked about the importance of understanding the sort of mentality of a smallholder and treating them as a rational agent. And a couple of the questions have said, why are we framing the question as, oh, it's so hard to work with smallholders, how do we get them to adopt stuff? As opposed to, why are smallholder farmers put off by what's out there? And perhaps we should question the assumption that everything should get high penetration. The assumption should be that we should be enabling farmers to take what they want to scale, but not that the project should be dominant and leading them to specific outcomes. So I wonder if you could both just share your thoughts on this whole sort of mentality of the farmer as stakeholder.
I'm happy to start. So I love this. I love the remark, and it's what actually our report says, is that give the farmers the tools to better off themselves, rather than disintermediating value chains and trying to fix a higher price for them. Give them the tools to and they will figure out how to increase their production and better off, become better off and sell higher, become a bigger seller or bigger buyer. However, for us, penetration is often a measure of success, meaning that if your value proposition is really attractive, more farmers will want to work with you. And it's perhaps a shortcut, but it's often a good one. If something is very good and brings a lot of value, then farmers want to join. All that said, some projects are very targeted in the number of farmers they take on for a specific reason, and that's fine too.
Thanks. Hugh, can you share your perspective?
Yes, Caroline, I think, and then the question depends what sort of project it is and what type of intervention you're talking about and what you're trying to achieve. I think the suggestion that the adoption rates under here are not what we would expect or not what we want is certainly not true across the board. We've got some fantastic projects in the portfolio where adoption rates are extremely high. And, you know, if I give one example, we have a poultry project which is involved in producing day-old chicks and then having agents that grow them for 40 days and then sell them on to individual farmers. And we calculate that upwards of 1.5 million farmers bought those chicks in the last year because they're much better than what they've got. But there are equally very good projects where, with the best will in the world, you can't involve more than 2,000 outgrowers. That's a very large number if you're going to engage directly, you can have direct contracts and whatever. And you say, well then, okay, you're not benefiting many people, but the actual adoption is probably very high. It's just not where you see the very big numbers. So yeah, they're rational, they're making the sensible choices. We used to say, didn't we, that, you know, that poor people in rural areas can't afford X, Y, and Z. What is the penetration of the cell phone today? People will afford what makes really good sense. It's up to us to get the right product, the right technology, package it in the right way, provide it in the right way, they will adopt it.
Thank you. Building on that, one point made by Mike to everyone in the chat function relates to another question that's come up on disruptive innovation. And your example from the poultry, perhaps. Mike pointed out that if you multiply the number of people by the benefits per farmer, the consumer projects seem to do better in your portfolio. But you've made the point that a range of different things are needed in the portfolio and the importance of disruptive innovation. And someone else has asked for an example of what do we mean by disruptive innovation. So if for the value chain integration projects like your well, perhaps you could explain any of yours. If the numbers of beneficiaries times the cash benefit per farmer are a bit lower, how do you see this value in terms of disruptive innovation and the balance between the numbers? Right. Sorry, I hear the breaking up a bit between London and Nairobi. Okay. Hugh, did you hear the question okay?
Caroline, maybe sort of. The issue here is, what are we in the business about? Are we in the business about transforming lives, or are we in the business of calculating a number of benefit? The comment is absolutely right. That if we were to add two things, if we were looking for two things, which is the number of households that benefit, we'd look at consumer type projects. If we're looking at the total value of development impact, it would still be in those because the numbers of people in households that benefit is very large. But at the same time, are we transforming lives? Now, there are other projects with relatively few beneficiaries where we really are changing their income. If they're at the poverty line $1.5, $2 a day, and they can change that and increase their incomes up to thousands of dollars per annum or whatever, we are really changing their lives. We're not saying which one is better. We ask our donors which ones they want. But, you know, that's the question. And I suppose the nice thing about what we're finding is that we, with the analysis, are beginning to understand which projects will deliver which outcomes. So it's almost like a menu that you can offer the funders and saying, what do you want? And maybe the USP of something like the AECF is in fact the competition platform that can be used to design bespoke competitions to achieve particular outcomes. I hope that was along the lines. I didn't quite address the disruptive innovation question, but hopefully people will understand what that means. What we mean by that is that it's a project that will have a wider impact on the market system which it's operating. I will give you one very quick example. We spent we have a project, not a huge one, with Kenya Biologics in Kenya, which we've had for a number of years now. They got money from us to help them develop bacteroviruses as pest control. These are natural, eco-friendly occurring bacteria or viruses that protect the plants in a safe way. In order to do that, to market those, they had to get permission from the Pest Control Products Board in Kenya to market these products. They're brand new products, completely new sphere. It took them 3 years to get the permission to market these. What that does is change the regulatory framework where now it's much more possible for another company to register similar products with similar impact. So we would back something like that because it opens up the market. The same would apply to potato varieties in Tanzania for reasons I don't want to go into. But there are many examples where either the project gets replicated because the innovation is disruptive and others have to follow, or it changes a regulatory and legal blockage or constraint to get to adoption, etc. So that's what we're talking about.
Fantastic, thank you. So you've said some of these projects are transformative on lives, and now you've described some others that are disruptive and transformative on the market. And just to finish on this point, and then we'll come to a couple of different questions, someone asked, how do you see the lead firm's role on value chain integration and how to engage them without distorting the existing market system? In a sense, you've said you need to distort it. But could you just clarify the role of the lead firm in these value chain businesses?
Well, we hope that the lead firm is not a lead firm, but lead firms. What we try to do, as I mentioned before, is to start races. We would like to encourage a number of companies into that space and not a single one. Obviously, there are cases where there are dominant players in the market and whatever, but the idea is if you're going to have a market systems impact, it isn't one large firm, it's a number of larger firms or even more numbers of middle-sized firms. That's when you get a working competitive market.
Thank you. Jessica, you've looked at these 15 case studies closely. How do you see the role of lead firm or lead firms?
I think it's. I think I'm going to skip the question. I think it was not really something we thought through.
Okay, that's absolutely fine. We have several questions left and running slightly short of time, so we're going to take these last 2 or 3 questions pretty quickly. First question to both of you. I do believe both reports touched on inclusion of the poorest farmers or the smallest smallholders in terms of land area. Can you just give a quick comment on what you view on that? Jessica, I think you should take this first.
Okay. Among the 15, the distribution was that about 1/3 works with very, very small and vulnerable farmers, meaning less than 2 acres or less than 2 cows per farmer. And interestingly enough, we saw that the performance or the results of the projects working with these very small farmers do not differ significantly from the others. So the good news, I think, is it's possible to be extremely inclusive when you work with very small farmers. And it's just the way you design the intervention. All that said, I think when you work with very small and vulnerable farmers, the companies doing so have a responsibility to think about how to protect them. And they cannot engage them into, high risk, high return schemes without giving them cushions or insurances if things fail. So I think it's possible to work with very small farmers, but perhaps build more cushions or have a different approach with those so that you ensure that these will not end up more vulnerable if things go wrong.
Thanks. Hugh, any comment on small farmers?
Yes. The goal of the AECF is that 60% of the beneficiaries should be classified as poor, in other words, under $2 a day or whatever that figure should be. To be honest, we don't have the data on the poverty status of the beneficiaries of our projects. What we are doing is that we're doing now a series of impact verification studies on the top 20% of the portfolio in terms of impact. And when we do those studies, it is then possible to collect data on the poverty status of the beneficiaries. It's not something that our businesses know intrinsically what that percentage is. I'll tell you the farmers are small or the farmers are poor, but we don't have hard data on exactly who the beneficiaries are and how poor they are. But we're working on that with a subset of the top end of our impact projects. Hopefully next year we can say more.
Thank you. I think we're happy to continue for a last 5 minutes, as we have various interesting questions still to canter through. If people need to disappear, we all have meetings. That's absolutely fine. But if our presenters are happy to hold on for the last few minutes, we will shortly wrap up. There was one question on AECF's preferred impact measurement tool, but I think that's documented in your report, and you already covered the last hard number, which seems to be one of the most valuable things coming out, and there is more data in the report. So we will leave that one. We have a quick question about whether either of you have experience of hackathons, which the answer might be very brief, and then we'll just touch on the finance requirement. So hackathons, does either of you have anything to say on hackathons?
Nothing for me.
Nothing to add from my side. Sorry.
Jessica?
No, nothing.
Okay, so that was a quick question. Now, finally, we had a question about financial services and financial inclusion for farmers. We actually originally had that in our quiz, and I'm afraid we decided not to go into that because it's a pretty considerable topic. So I'm going to ask, but I know you both have interesting findings, including where there's some difficulties, if I'm not mistaken, Hugh, if I remember correctly. So perhaps you could both just share a couple of sentences on your perspectives of access to finance for farmers. Jessica, yes. Will you go first?
The AECF original purpose.
Sorry. Go ahead, Hugh. My fault.
The original purpose of the AECF did involve rural financial services, and we do have a subset of around 20 projects that are directly financial service projects for agribusiness. We also have another set of projects in the portfolio which are not primarily financial service projects, but they do have a financial services component. In the coming year, that is one of the subsets of the portfolio that we will be investigating and looking at. What are our findings so far? We went quite heavily to try to help push mobile money in some difficult locations, Sierra Leone being one, and some other, South Sudan, and sorry, not South Sudan. But mobile money, the conclusion we had there, that this is not one for us. One of the findings is that mobile money is about very, very large numbers of very, very small transactions. And to grow to that size, experience suggests that they have to be backed. The company has to be backed by a large company that has lots of capacity to do marketing and whatever. That applied obviously to M-Pesa in Kenya, but it also applies across the board. Where we have made an impact in that is in CABS in Zimbabwe, which is Old Mutual. It's got a big backer behind it. So mobile money is a big boys game, and quite difficult for us, we felt. Where we are making more progress in the agricultural space, we think, is in trying to promote more asset-based lending for small machinery and for other farm equipment and whatever. There is scope on asset-based lending. It's even bigger, interestingly enough, in our REACT renewable energy portfolio for home-based solar products, where the asset-based leasing model is proving very successful.
Thanks, Hugh. Jessica?
Yes, I think Hugh has way more insights on this. Most of the projects we're looking to provide some kind of financing solutions to the farmers. There is a whole report, a chapter in the report that looks at best practices in lending to small farmers and ensuring a high repayment rate. It has a lot to do with group dynamics. It's no news. We know this from microfinance. But what is interesting in the small farmers is that it makes also a lot of sense to group farmers to work with them, not only when you lend money, but when you deliver training and when you want to scale up your operations. So there is a lot of synergies between training and financing and so on. And there is something like 6 or 7 good practices on how to lend to small farmers if you want to read more in the report.
Great. Yes, indeed. I do recommend going into that. Thank you very much. There's several reasons I like these reports. Partly, it's very positive. I must say, when we ended the Business Innovation Facility pilot project and we had a larger sector was agri, and our final report back in January 2014 said, actually, it's the ag sector projects that are struggling most. Your 2 reports do show that real progress can be made, but they're also quite frank as to where some things don't work so well, plus the fact you're actually drawing on data and being transparent. Is there anything else you would like to add about where you've seen things that don't work so well, just while we continue this honest, reflective theme before we wrap up? Hugh, first.
Yeah, an interesting one. Yeah. I think where we're seeing some of the really tougher ones have been, as I mentioned before, in the financial services arena, with mobile money and things like that, which have been difficult. Our portfolio, is split up into different funds, and we have a special fund for post-conflict states. And there is no doubt that doing our portfolio in countries like South Sudan are really struggling in comparison to where we work elsewhere. I think one of the things which is not really so much along the agribusiness stuff is actually about the challenge fund mechanism itself. We've got to find ways to make this thing faster. It is too slow, too ponderous. We understand it's taxpayers' money and that you need all the checks and balances, but it's a really good idea. It's innovative, and it's got a now thing about it. If it takes the business a year to get our money, then we need some changes. So rather than pointing fingers at the businesses, maybe we should point fingers at ourselves, and we've got a lot of challenges that we need to deal with.
Very self-reflective and honest. Thank you. Jessica, you found various things that didn't score so many ticks and successes. Any quick comment on what doesn't work?
Yeah, very quickly. I think working with small farmers, one realizes that you cannot just be transactional. It's their livelihood, it's their inheritance, it's their everything. And so what we've seen with projects is that building trust and seeing the farmers, investing into the farmers for the long term was extremely important. You couldn't just be transactional and and say if you buy, you buy, if you don't, you don't. The second thing for me, which was very insightful, is that you need to propose farmers full solutions. If you give them an improved seed, you need to show how to plant it. And if they end up tripling their production, then perhaps you should find ways to help them sell that production. So the more you go into providing more holistic solutions for the farmers and more integrated solutions for the farmers, not only it's good for the company because the company makes more money and has more loyal farmers, but it's also more attractive for the farmers to say, And the last and perhaps most important finding for me is that stop talking about farmers like recipients that are always being wronged in the process. They are quite rational and gifted people. And if you give them the tools and the means to cultivate their land or raise their cattle in better ways, they will often do it in spectacular manner. And this is extremely powerful, rather than having this assistentalist way of thinking, oh, the market is broken, we need to fix it for them and ensure that somebody gives them a good price and put some fair trade premium. You're just replacing an evil by another. You're making these people still as dependent on somebody as they used to be in the past. So my final work is work on give them the means to for them to get better by themselves. A basic development insight, but I think it holds true for in this case too.
Thank you, Jessica. I was worried that I was finishing on a rather negative question about what doesn't work, but I think that's actually a very inspiring way to finish, about the potential of investing in farmers for them to do it themselves. I truly want to thank you both and your organisations and your teams very much for sharing your insights, not only on the webinar, but in your reports. To all of you who have participated, thank you very much. I urge you, join the conversation on Twitter if you're a Twitterwriter. Visit the webinar page where there's a host of other resources, and soon you will see these slides and a link to a recording. And please do, if you're not already, join the Practitioner Hub, and then you will get our monthly updates, including, I'm sure, more from both these organisations in the months to come, and invitations to future webinars. So on that basis, I thank you all very much indeed. Have a good rest of your day.
Thank you, Karen, for great moderation and bringing us together.
Thanks. And thank you, AECF, for hosting the technical side as well as the sharing the experience.
Thank you, Caroline, and thank you to the team here for doing such a great job.
Good job. Cheers all.